Okay, question 12. Raj is a both customer and supplier to Barbie. Raj account in Barbie sales ledger. Okay, this sales ledger means that credit customer. Okay, and then there was a credit balance of 100 on the purchasers ledger. This is a credit supplier account. Okay, so based on this one, I open the two account. So Rush account, this is under sales ledger. I have balance brought down 300. And then under purchases ledger, Rush account, this one balance brought down is 100. Okay, the credit balance. So a contra entry between the two accounts. Which entry will Barbie make in his purchases ledger control account? Purchases ledger control account is referred to this one, purchases ledger control account. This is a total, this is an individual, but the position are the exactly same. So to reverse this 100, this is 300, this is 100. So we have to take the smaller amount. This is a smaller amount to reverse for the contra. So the contra entry will be sitting in here. Debit here and credit here. So the question is asking purchases ledger control account, which is this one. So here, debit 100. Okay. Now next, move on. Okay. Question 13. Motor repair 200 were debited to motor vehicle. So this is a error or principle. Okay. Motor expense, that means this one understate, this one overstate. Okay. Extra, this is less, this is extra. Motor vehicle are depreciated 20% on the balance of the account at the end. What is the effect of this error? When we charge into here 2000, I had to times 20% depreciation, so I get 400. This depreciation you charge to the expenses. Okay, expenses were increased by 400. When expenses increased by 400, profit decreased by 400. When I come to this one is the omission, omitted. Okay, so when this one omitted, expenses understate by 2000. So understate by 2000, profit will overstate by 2000. So now effect on the profit for the year, this is this one and this one. One increase, one decrease. So the net will be overstate by 1006 for it. So now this one we tick already. This is the effect on the statement of financial position under motor vehicle account. Because this amount, you're going to take 2000 minus 400. This 400 is because of depreciation, provision for depreciation. So your this net effect for the non-current asset will overstate by 1006. Okay. Once okay, let me know. We move on.
Yeah.
Okay. Next Okay. Question 16. A bookkeeper make the following: debit bank, credit, debt recover. Which transaction has been recorded? A credit customer has paid his account by due date. This is the normal transaction. We should debit bank, credit, trade receivable. Not go through this one. A late payment has been received for a debt not yet written off. Not yet written off. When we receive the payment, we just do like this only. Okay,
Mm.
debit back, credit trade receivable. A payment has been received for a debt that has been written off. When we have written off the account, we do not have the trade receivable. So that's why we go and credit the debt recover. Okay, an irrecoverable debt has written off. This double entry will be debit, irrecoverable debt, credit, trade receivable. So the entry is talking about this one.
Mm.
Okay, I move on.
Mm.
Okay. This one is okay. The total following appear in the ledger of Delta. Total, this is a trade receivable because this is a sales, this is a bank. And then this is a provision. So I can't see the number. Let me see what is the information. I also not sure what is the information. How has the total trade receivable the rate for change by the end? Can you check your question? What is the number for balance CD?
CD is 1,100.
1,100.
Yeah.
And okay. How about balance BD for trade receivable?
30,000.
30,000. Okay. So here they say that the change of total trade receivable and the rate of this one. So we have the information total of the trade receivable, which is this and this. This show that 30,000 to 22,000. That means this is a decrease. But now this is a rate. Rate we have to calculate. Beginning year 1,002, 30,000 times 100%. Okay. End year is 1,100 divided by 2,200 times 100%. So calculate the rate first. Let me count. 1,200 divide 30,000 times 100. So I get this one 4%.
Mm.
Whereas 11 divide 22 times 100. This one I get 5%.
Mm.
So this is an increase. This one is an increase compare beginning and the end.
Mm.
Okay. Now next. Later you refer back to the recording.
Okay.
Okay. Question 18. What was the total? I cannot see. Total. Give me a minute. Because I can't really see the question. I open side by side the file. Give me a minute.
Okay.
Okay, let's continue. Okay. On 31st December 2020, Hermit has the following liability. So what was the total non-current liability on 31st? So bank loan repayable 1st September. This is less than a year. Okay. So if less than a year, this is a short term, which is current liability. Bank overdraft, current liability. Loan from finance repayable, this is more than 1 year. So this is non-current liability. Mortgage pay 2022. This is also more than 1 year. So this is non-current liability. So the total should be 7,000. Get it?
Yeah.
Okay. Now let's continue. Okay. Vinita credit customer pay amount owed in cash after deducting 2% discount for prompt payment. How did this affect Vinita financial statement? So we do the double entry first. We were going to, because credit customer pay means we debit bank. Okay. And debit discount allowed. And we credit trade receivable. For example, if the trade receivable pay 100, then we'll give $2 discount allowed. So the bank only received 98. So how did this affect financial statement? Income statement is talking about this discount allowed. Discount allowed is expenses. So expenses increase, profit will decrease. So this one, expenses increase, expenses increase. Statement of financial position is talking about this current asset. These two are the current asset. This is current asset, this is current asset. Current asset, debit side is increased, credit side is decreased. Here you receive 98, here you reduce 100. So the net will be decreased 2. So this one decreased $2. So the answer should be A. So far, okay, can follow? So far, can follow?
Yes.
Okay, let's continue. Okay. Mohan and Deepa are the partner. They provide the following information. How much was available for distribution to the partner? So profit, interest on capital had to minus. Interest on drawing had to plus. Salary had to minus. So this one plus, minus, plus, minus. So the net balance share of the profit, 30 minus 250 plus 360 minus 4,000. So we get net is 24460. So this is the amount to share by the partner. Okay. Can move on?
Yeah.
Okay. The next one. Okay, question 21. Yeah. Okay, Raj and Rohit are the partner. Share the profit and loss in ratio 2:1. Rohit entitled annual salary 3,000. The profit for the year is 14,100. On 1st Jan 2020, current account is in the debit side. So that means we have current account 1,008. Okay. So what was the credit balance current account on the 1st Jan? Okay. So beginning here is a debit balance. Now I have the profit for the year. Profit for the year is 14,000. So 14,100. I had to minus the salary, which is left with a 1100, 1100, 1,111 and 0, 11,100. And then the ratio share is 2:1. That means Rush will get 2. So I have to take 11100 divided by 3 times 2. So I will get divide 3 times 2. So I get 74. So this is share of the profit. Share of the profit is sitting in the credit side. And then Raj also get the salary. So salary is also in the credit side. So take these two, 7,004 plus 3,000 minus 1,008. So we get the balance 8600. So this amount is balance CD here. So it will bring it to here, beginning of the year, becomes sitting in the credit balance, which is this amount.
Mm.
Okay, next move on. Okay. Which item appear in the capital and reserve section of the statement? This is a limited company account. Under this section in the IG syllabus, you only need to memorize 3 things. Share capital, general reserve, and retained earning. Whereas this debenture is under non-current liability. Okay, next. Okay, 24. Which group contain only item which may be recorded in both income statement trading of a trading account and the income statement and expenditure account of a club? Okay. Bank charge possible, depreciation possible, wages possible. Okay, come to this gross profit. Gross profit for the income and expenditure, they don't have the gross profit. They will just have income minus the expenditure. So we get the profit, and no, get the surplus or deficit for the club account. Whereas for the income statement, you will get the profit or the loss. So this one only appear in the trading section. If a service section, this one also don't have. Okay, deficit, this is under club account. Sales revenue reserve, this is under income statement. Treasurer expenses, this is under club. Depreciation, both also appear. Treasury expenses under club only. Wages, both also will appear. So in this case, answer all will be A. Okay, now let's continue. Question 25. The following ledger account appear in the book of club. So subscription, balance BD in here means that current asset. So means that there's a member didn't pay the fee yet. Okay, this is a collection for the year, total collection for the year. This is the should be recognized as an income to the club. Okay, the total income for the year. This is means that current liability means some of the member pay the club. This is a pay in advance from the club, or the club receive in advance a liability to the club. So in here, which one statement is correct? Subscription prepaid on 1st Jan amount to, this is subscription not prepaid. Okay, prepaid means it's a liability, but this is asset. That means accrued. This is an income account. Income accrued is an asset. Subscription prepaid on 31st. Yes, this one 3,000 is a liability, which is member pay in advance, prepaid. Okay. Subscription received during the year 31st amount to 24. Amount received is this one, 29,000. Subscription related to the year ended. This is referred to this amount, income and expenditure. Okay, so the answer will be B. Okay, next. If anything, just stop me. Okay, question 26. The following costs incurred. This is a clothing manufacturer. They're asking indirect costs. So we need to take notes that manufacturing account, for manufacturing account, you need to have prime costs and the factory overhead. So indirect cost is factory overhead. Purchase of fabric, this is a clothing. That means this is a prime cost. But buy button, also prime cost. Repair is a factory overhead. Wages of factory supervisor. Supervisor cost is a factory overhead. If a worker is a prime cost, okay? Wages of sewing machinist, this is a prime cost. So indirect only have 3 and 4. So 3 and 4, donkey. Okay, next question 28. Okay, Tarif provide the following information: non-current asset, current liability. Tarif drawing for the year 31st Jan 2021 worth 5,000. What was the profit for the year? So we open the capital account. This one, it will become the opening. Okay, opening to this one. Okay, so now I calculate total asset minus total liability. We have 80 minus 80 minus 15. I get 65,000. So my opening balance for capital is 65,000. Then my end balance is 70 plus 25 minus 19, which is 76,000 here. Okay. Then we have drawing. Drawing is a 5,000 here, debit here. And we want to find the profit, which is taking the debit minus the credit. 5 plus 76 minus 65. So we get 16,000. So the answer should be donkey. Okay. Now next, a trader provide the following information: non-current asset, current asset, interest paid on loan. Okay, ROCE and return on capital employed, ROCE. So ROCE formula is a profit before interest divided by capital employed. Okay. Okay. What was the profit for the year before the interest? So we have non-current asset and current asset, interest pay on the loan. So this one, the net is this one plus minus 132 plus 28 minus 12. We get 148,000. This is a capital, okay? And then in here, they just mentioned interest pay on the loan, but we do not know how much of the loan. So in this component, we have capital plus the non-current liability. So we need to take profit before interest divide capital. Capital is 148,000. Okay. And then we do not know what is the non-current liability, which is the amount should be the loan, but don't have the loan information. We're assuming this is a 0. Okay. And then times 100%, then we will get this 12.5. 12.5. So this one, bring it to there. So become profit before the interest will be 12.5 divided by 100 times 148,000. So we will get 12.5 divided times 148,000. Okay. So we get 18,500. So the answer should be C. Okay. Next is that which change or cost increase in the liquid asset. Okay. Acid test. Acid test is that current asset minus inventory to the current liability. Basically, don't include the inventory. Okay, just take trade receivable, bank, cash, other receivable. Okay, since that not include inventory, that means these two must be out. Don't need to see already. Well, these two, a decrease in the provision for doubtful debt. So when this decrease in the provision for doubtful debt, I'm talking provision for doubtful debt account. When you have a decrease, means that let's say your balance brought down in here 100 or 1,000. Now you have balance CD. Decrease means balance CD lesser than the opening. Let's say it become 800. So this is called decrease. When your this decrease, one of the item here is the trade receivable. So your trade receivable minus provision for doubtful debt, you get the net trade receivable. So when this one decrease, this one will increase. Get it? Whereas this one increase, this increase, if this is increased, means that another scenario for this T account. The provision for doubtful debt, here balance brought down 1,000. Balance CD When it's increased, that means this amount will be, let's say, become 1,005. So that is called increase. When this one increase, net trade receivable will decrease. So in order to increase your this amount, current asset must increase. So we should choose the C. Okay, next. What was the rate of inventory turnover? So here we have formula. First of all, for the chapter, you must memorize the formula. We have cost of sales divided by the average inventory. Okay, our cost of sales, we are doing the 31st 2020, which is this one. That means we have to take this one. 12400. No, 120. Sorry, this one. 120. And then our average inventory is the opening and the closing. This is a closing, but come to 2020 become opening. So we take these two. So you divide 4,000 plus 8,000 and then divide by 2. So we will get 12000 divided by 12 divided by 6,000. So 6,000, 120 divided by 6. We get 20 times. Okay. Okay, next. Okay. That's all so far. Okay, let's see one by one. Okay, question number 2. Okay, what is an asset? Asset, something belong to you. An amount owing by credit customer. Customer means trade receivable. Trade receivable is our asset. Okay, next is okay, question 3. Fatima required additional finance for her business and borrow fund from where? From Ali. Okay, this one is he borrowed from Ali and deposited into the bank. The mean bank receive money. When you receive debit, who giving out? Ali giving out. So Ali must be credit. So how Fatima record it? Debit bank, credit Ali. Why we need to put loan? Because this is borrow fund. Borrow fund means loan. Okay, next. Okay, question 7. Jacob settled the account of Ahmad, a credit supplier. He made the following entry in the side or in the credit side of, give me a minute. So in the credit side of his cash book. So this is a credit side in the cash book. So he settled the account of Ahmad. That means he pay Ahmad. Which entry did Jacob make on the debit side of Ahmad account? In Ahmad account, this is Ahmad account is under the purchases ledger. Okay, Jacob under purchases ledger will record debit side. In here, he will put bank. He will put discount receive. Because supplier, this is a supplier. Supplier is discount receive. So these two amount, this is discount receive. This discount receive will be sitting in here. So the answer should be donkey. Okay. Next is that the total of the debit side of the trial balance was more than the total credit side. So this trial balance, debit and credit. So debit more. One account balance has been entered in the wrong side. Which one was it? Cash should be debit.
Mm.
Discount receipt should be credit. Drawing
Mm.
should be debit. And then irrecoverable debt should be debit. So what possible that wrong side? This is one put into the debit, cost debit more than the credit because these all are debit side.
Mm.
Okay, next. Okay, question 9. Davy prepared the following. This is the journal entry for correction of the error. These two are the name. Okay, what could be the possible for this error? So cash pay to Samuel. When we have the cash pay to Samuel, we should in the Samuel account and the cash account should be this one and this one. Debit Samuel, credit cash. So now we need to put back, that means this possible error adjusted for this one is this one omitted. We go and put into the Samuel. So in here. So now we need to do the reversal of the entry. So we will credit Samuel, debit Samuel. This is to reverse the error. This is to put back the correct side. So the answer should be A. This one you correct. I don't want to ask. I don't want to discuss. Since that you are right. Okay, question 12. Jack cash book show an overdraft. Overdraft means overdraft. So means that your bank account should be balance brought down here, 2600. Compare the cash book with the bank statement. It was discovered that direct debit 200 has not yet recorded by the Jack. Means that this direct debit is reduce the money in the bank. Means that this side direct debit 200. He has not, he then update, so means have to put into the credit side. What was the bank balance in the updated? So this one will become balance CD 2800. This 2800 will be balance BD into here, 2800. Still in the credit balance, but the amount will change it into 2008.
Mm.
Next. Okay, question 15. Okay, which item should be treated as capital? Capital expenditure is the money spent on purchase of non-current asset or the improvement of the non-current asset or extension of the non-current asset. 3 items for this one. Or possible also when you have you pay loan, pay back the loan. That is also considered capital expenditure. Okay, so in here, annual depreciation, this is a non-cash item. So this is not related. We didn't pay money out. The cost of building an office extension, this is a non-current asset, which is under extension. So this one should be capital expenditure. The cost of repair, when you saw the word repair, this is revenue expenditure. Purchase of a new computer, but behind it got one word, resales. Resales means that goods. You buy computer, your business is buy computer, sell computer. This is consider revenue expenditure, not the capital. So take notes for the differences. Okay. Next is that for the 16 now. Okay. On the last day of the financial year, Khalid purchased office fitting 900. This was incorrectly recorded. So expenses, this is non-current asset. So we recorded as office expenses. That means expenses overstate, non-current asset understate. So Khalid does not charge depreciation in the year of purchase. what was the effect on the profit for the year? When your profit expenses increase, profit will decrease. But decrease by how much? 90 only. Because they say here they not charge depreciation in the year of purchase. That means no depreciation. So in this case, our profit should be understated by 90 only. Clear? Can?
Yes.
Okay. Next is 17. Angie is a trader. She used the following method of depreciation for different type of the non-current asset. Straight line reducing revaluation. On 1st Jan, year 1, Angie purchased small item. Small item of equipment cost 2004 and fitting cost 8,000. On 31st December year 2, Angie estimate the equipment was worth 70% of the original cost. The statement of financial position show the net book value of equipment as 1,680 and feature as 4,800. Next is, which depreciation method has Angie used? Okay. When they say small item of equipment, this one normally we use revaluation. Okay, and they say that here, non-current asset value at on year 1, this amount 2004. And year 2, they say that the equipment was worth 70% of. That means your depreciation under revaluation, this one you should get 30% depreciation for the year 2. Okay, and then the statements of financial position will show that the net book value equipment. So this one, in this case, you should take in order to find your depreciation. Your this one is not relevant. You take this minus this to get your depreciation amount. Means that, sorry, this is the first year, this is second year. We need to calculate second year. How we going to calculate here is that I want to calculate the second year. First year cost 2004 on year estimate the how come they didn't show the year end? Let's see. This is year 1, this is year 2. If I don't have the depreciation, I take this one 70 because 70%, assuming the year 1 is also 70% times 70, my net book value 70, I get 1680. Second year, the depreciation, I'm calculating depreciation under revaluation. So 1680 times 70 again. So I get, or that means, I think this one's something wrong. This one should be 1 year only. This one should be 1 year because based on the calculation, this one is 1,006. That means this is should be typo error. This one should be year 1 only. Okay. Now come to this one. What method that we use? This one is beginning, you have 8,000. If I'm using 20%, I should get 1,006. Okay, take the 1,006, my net book value 8,000 minus 1,006. I will get 8,000 minus 1,006. I will get 6,004. But this amount is not that I get. So this one is 20. I minus another 1,006. Okay, let me calculate, see whether can get or not. 4,008. So I get 4,008. This is second year. Okay. And That means second year, they don't have the depreciation. Why so weird? Another question. Because this one, the fitting, if I using the straight line method, the second year, I get this one, which is they using the straight line method. Okay, which is straight line method, straight line method. But if I'm using revaluation for this one, I get my equipment is 2004. 2004, I times 70%. Okay, 70%. Then the next year, second year, if I want to calculate the second year in here, now I wanted to calculate second year. Second year, I should take this balance 1680 times 70%. Okay, then I will get another depreciation. But seems that this one, if normal revaluation method, the formula we were going to use is we take the balance what down plus if any new purchase, we minus the balance CD, then we will get the depreciation amount. But if I take this opening, this balance is 1680. Okay, and then calculate the second year. My end of the year is second year is 1680. That means my depreciation is 0. So there's something wrong with the this information. Sounds that this second year is refer to the fitting, not refer to this one, because the revaluation second year seems is 0. Normally, when we saw the small item, we will use the revaluation method. Can understand? Okay. Now, I believe this one's got some issue on it. Okay, next is question 18. Abel's prepare financial year end. Abel bought machine 40,000 on first year. He charged depreciation on machine 20%, reducing balance. This is the first year. Depreciation is charged in the year purchase, but not in the year of disposal. So on the 1st Jan, year 3, the machine sold. That means how many years he used? He used for 2 years, the asset. So the calculation for this one is that the first year, 40,000, this is the first year, times 20%. So we get 8,000. Second year, we want to calculate depreciation because this is a reducing balance method. So I take 40,000 minus 8,000 and then times 20% again. So I get 32,000 times 20%. I get 6,004. So the total accumulated depreciation will be these two plus together. So I get total depreciation is 14,400. Now I want to calculate profit or loss. I use a disposal account. The cost is 40,000. So I put in here cost 40,000. Accumulated depreciation, which is these 2 years, because third year they dispose, no depreciation count. So here 14,400. And then we get the money 22,000. This is a receipt amount. And then now this amount total is 36,400. Debit more than the credit. So it means that we take this minus this 40,000 minus 36,400. We get 3,006. This 3,006 is a loss. This loss, we will debit income statement, credit the disposal. So which one account? Debit income statement, income statement. The amount is 3,006. That means this is a donkey. Okay, let's move on. Okay. Question 20. Angie maintained a provision for doubtful debt of 5% of the trade receivable at the end of each year. At start of the financial year, the trade receivable is 2,000. At the end is 4,005. So I open the provision for doubtful debt. Balance brought down. We take beginning year 2,000 times 5%. End year balance CD, we did 4,005. 4,005 times 5%. So we get 4,500 times 5. So we get 225. Whereas this one 2,000 times 5. So we get 100. So this is an increase. So this increase, the differences we had to see into here, which is 125. To get the total debit credit are the same. So this this credit provision for doubtful debt in the income statement will become debit. Income statement debit is a expenses. Credit is an income. Okay. So in this case, this will be the expenses. So 125. Okay. Next up. Question 23. A trader bought a machine for use. Okay, let me count first. He paid a part of the cost in cash and pay the remaining. That means this is the payable, other payable. Okay, this is a cash account. So your double entry debit machinery and credit cash, credit other payable. Okay, this is a non-current asset. This is a current asset. This is a current liability. Asset, liability. Asset, debit is increased, credit is decreased. Liability, debit decrease, credit increase. So here now they say that in addition to the non-current asset, which item in the statement of financial position will increase as a result of this transaction? They are talking about the current liability, current asset and current liability. This one not involved. So not involved, you saw only one cross. So definitely the answer is this one. Okay, so now here that this one debit. No, this is credit. Credit means decrease. Sorry, this one something wrong. Let me see one more time. Give me a minute. Wait, let me clean up this one. This one something not right. I don't think so. Okay. Yeah. Because my credit means that this side reduce. Okay. When this one reduce, this one A is not. Because they want increase only. Then not is correct lah. Then this answer should be correct. Okay. And then here current liability. Current liability, this side is a credit. Credit is an increase. So they want increase. That means this one correct. Just now, this one not included. This is also, that means answer C is correct. Because they want increase. This is decrease. Okay. Can move.
Let me check the marking scheme because the answer, I think the answer was D.
You check. I believe answers should be C. So what is the marking scheme?
What year is it again?
This one 22.
22. Okay.
February, March 22. 22. I think it's 22. Let me see the down there. Okay, the paper February, March 22.
Okay. Marking scheme says in D.
D, yeah.
Yeah.
Let me see the marking scheme. Give me a minute. I'll open the marking scheme first.
Okay.
22. Okay. Yeah. Then question 23. Why is D? Cannot be leh. Okay, let me analyze one more time. Wait. Where's another question? Wait, let me see one more time. Why is the D? A trader bought a machine for use in the business. So debit machinery. And then he pay a part of in cost in cash. So credit cash, and agree to pay the remainder in the 15 months later. Oh, I know why. Sorry, why? This is more than 1 year.
Oh.
15 months. There is non-current liability. This is non-current liability. That means that this one involved, this one involved, this is not involved. So the answer B or D. Now next, we look into it. So just now we analyze already, should be this one. So that's why the answer is donkey, because of this one 15 months.
Okay.
Okay, next 27. Okay, next is a limited company formed on June. On there, the issue share capital, then we're asked to pay 60 costs. Okay, 50, 500 times 60, we get 50,000, 500 times 6, we get 300,000. And then the remainder 40 pay on the first, this by 1st August, all shareholder has paid and was due. What was due on the day? What was the share capital of the company on the 1st August? Okay. What is a call up capital? Call up capital means that they call us to pay. That is called call up capital. So the calculation just now is 300,000. So either this one, there's no others already. Okay. Next is that pay. What is, they say that all the shareholder has paid. Has paid means that this total, the amount they call, everybody pay out already.
Okay.
Okay, question 28. They are 120 member. The annual subscription, that means this times this, 120 times 60, we get 7200. Okay, this is the income and expenditure amount. Okay, total for the year. At the beginning of the year, no member has paid in advance and no member has subscribed. That means there is no balance BD in the debit side or credit side. At the end of the year, 7 member has not paid. This is a current asset. Not pay means asset. So you take 7 times 60, which is 420. Whereas 3 member pay in advance. This is a current liability. 3 times 60, 180. So which amount was shown for the income and expenditure account? The key thing is income and expenditure. We open the subscription account. Beginning year, balance brought down don't have. And in here, they say This is a income and expenditure 7200.
Hmm.
End of the year, we have current asset, which is balance CD, 7 times 6, 42. Okay. And then this is a liability, balance CD, 180. The information short is a bank, which is how much that we receive from the subscription. We take this one plus this one, 7200 plus 180 minus 420. So we get 6960. But the question is asking, what amount was shown for subscription in the income and expenditure? They are asking this information. Get it?
Okay.
So the last sentence is important because initially I also thought they asked for this one, but last sentence talk about income and expenditure. So this one is this one.
Oh, okay.
Okay. Next is okay, 30. Harry produced a statement of affair at 31st December. Okay. During the year 2, his long-term loan increased by 3,000. Okay, and his net current asset decreased 1,000. Depreciation for the year was 500. By how much did the direct capital decrease? Okay, this is a year 1 and year 2. Asset liability. Okay. During the year 2, his long-term loan increased by 3,000. Liability increased 3,000. And his net current asset means current asset minus current liability. Decrease, that means this one decrease 1,000. Depreciation for the year was 500. Depreciation will cause the non-current asset decrease by 500. By how much did the total decrease? So 2 decrease 1,005. 1 increase, the net will be increase 1,000. Wait, let me see where the thing goes wrong. This one is which year? Year 1. Okay. The capital decrease. Yeah, let me count. Asset equal liability plus capital. So my asset, my liability increased 3,000, and then my asset decreased 1,005. So this is plus, this is a minus. Okay, bring this one to here. Negative 5,005 minus, this is positive, bring it to it, become minus. Minus 3,000. So we get C. So C will be negative 4,500. So the capital should decrease by 4,005. Okay, using accounting equation.
Okay.
Next is question 32. A trader provide the following information for the year ended 31st December. Okay. His trade payable is 8,000. Trade payable turnover. So the formula is trade payable divided by the credit purchases. So 8,000. And then credit purchases is, this is non-current asset, no. The cash purchases, no. Total cash and the credit purchases. So we have to take this one minus this one. So it's 150 minus 17. Then times 365. So we get 8,150 minus 17. We get 8,000 divided by 133 times 365 days. So 8,000 divide 13300 times 365. So we get 221.95. Whenever this number got decimal, you just round up. Whether less than 5 or more than 5, also round up. So you should get 22 days. So this chapter formula is important. Okay, next. Okay, question 33. A trader decides to reduce her level of inventory in order to reduce the storage cost. Sales quantity and selling price were not affected. How did this affect the profit for the year and the rate of inventory turnover? Okay, the profit for the year, we have used the income statement. Revenue minus cost of sale. The cost of sale component, we have opening inventory, purchases minus closing inventory. Then we get gross profit, we minus expenses, we get the profit. Whereas rate of inventory turnover, we have cost of sales over the average inventory. Okay, divide by 2. This one you have to take the opening minus the closing, plus the closing, divide by 2. Okay, now next is that they say that a trader decide to reduce level of inventory hold. That means this one, okay, this one component is opening inventory plus closing inventory divided by 2. Our closing inventory will reduce. This reduce cost of sales increase. Cost of sales increase, gross profit decrease. Gross profit decrease, profit will decrease. So this profit for the year should be decrease. Okay. Next is that, okay, let's see. Level of inventory in order to reduce the cost. Sales quantity and selling price are no change. Okay, how did this affect for the year? Reduce level of inventory, closing inventory reduce, and then cost of sales increase. Cost of sales increase, gross profit decrease. Profit should be decreased. Why you say this one is increased? Let me check one more time. Okay, rate of inventory turnover when closing inventory decrease. Okay, so this one decrease, this one should be decreased. When this one decrease, overall for this rate of inventory will be increased. So this one should be increased. The answer should be B. Okay, let me check the marking schema. 33. Okay, 33. 33 is donkey. Why is donkey? Let me see one more time. Reduce her level of inventory in order to reduce the storage. Okay. Here. This is the information. Income statement, revenue, less cost of sales, opening inventory, purchases, closing inventory, and then gross profit minus expenses, and then profit for the year. This closing inventory decrease, my cost of sales increase. Okay. But when we reduce the level of inventory, means that we have lesser purchases. Get it? means that we reduce the purchase because they say that sales quantity, selling price no change. This one no effect. When we reduce the inventory, basically we are reduce the purchase item. So this one reduce, that means this one become no effect. Okay. Next is that come to this one storage, reduce the storage. That means this is decrease. When expenses decrease, profit will increase. That's why is increase. Next, come to the rate of inventory turnover. ROC, rate of inventory turnover formula is a cost of sales divided by the average inventory. Okay, the average inventory here is the opening inventory plus closing inventory divided by 2. Okay, this reduce means that average inventory reduce. When this one reduce, this one should be increased. So that's why both also increase, because this one, what they meant for this here is that when I reduce the inventory, basically I reduce my purchase, then only my closing inventory will reduce because quantity no change. Okay, that's the main for this part of it. Okay, next move on now. Okay, this one 35. Yes, Stephanie, major competitor, invest in the new machine for making goods more cheaper. Stephanie know this will affect her sales, but did not record her accounting record. Which accounting principle? Okay, first going concern is talking about continuity of the business. The business assuming continue forever. Materiality is talking about the value of the item that we record can be recognized as a non-current asset or the expenses, depending on the value of the item that we pay. Money measurement is talking about whatever we want to recording. For the recording, we must have the real money that we have the document or the value in order for us to do the recording. We cannot simply do the recording. Prudence is talking about the profit and the asset, not to overstate. Profit and asset, not to overstate. Losses, not to understate. There is a prudence. So this one, why we didn't do recording? Because it's not buy by us. So that's why we don't need to do the recording.
Oh, okay.
Okay, now next is, okay, that's all for this paper. Let's see. Which statement about the book of bookkeeping and the accounting? Okay, the key word for the bookkeeping must be the recording. And bookkeeping start from the journal, okay, document, business document, and then up to the trial balance. The rest will be under accounting. Accounting basically using the bookkeeping information to prepare the financial statement. After prepare the financial statement, then they had to analyze. They had to monitor. They had to make the decision for the boss to make the decision. So keyword bookkeeping, recording. So from here, that what we're going to do, accounting is performing periodical rather than daily. What do you mean by periodical? Like example, account department normally do the account by month only. Every month, month end, they will start to prepare the account, not every day. But bookkeeper, they do daily work because when you have sales transaction, you have to do the recording. Okay. Next is that this is periodical. This is correct. Accounting rely on heavily of the accurate, yes, because they are taking the recording from bookkeeper to prepare the financial statement. So this one also correct. Next is that bookkeeping include prepare the financial statement. As I said just now, accounting is the one prepare financial statement. So 3 all out. So these two possible. That means 2 and 4 are the answer. Since that 1 is here tick, so the answer should be A. And the keyword here, bookkeeping, recording. Okay, number 2. What increased the owner capital? We think about asset equal capital plus liability, or capital equal asset minus liability, the accounting equation. Bank loan extended from 5 years to 10 years. This is from 5 years to 10 years, both also non-current liability, also liability. There is no effect for the capital. Purchase of inventory on credit means that I'm going to debit purchases, credit the trade payable. These purchases, it will go to the inventory because you keep the stock, keep the inventory in the warehouse, which is in under the asset, this one. Whereas this is under the liability. So here increase, here also increase. There is no effect on the capital. Purchase of machinery by check. Debit non-current asset, credit bank. Non-current asset increase, bank decrease. Both also under the asset. One increase, one decrease. No effect to the C, capital. Transfer of vehicle to business from. The moment you saw private use, this is the additional capital. So double entry, debit vehicle, credit capital. When you credit capital, this is an increase. So increase capital. Okay. Okay, move on now.
Mm.
Okay, questions 5. Okay, Hashina buy radio from Nazini. This one, seller. Okay, this one is a buyer.
Mm.
Okay, at the list price of $10 each, Hasna buy 12 radio and offer 20 trade discount. So that means that the list price here, how much they have to pay only? 10 times 80%. This is what he pay only. And 4% cash discount. This is when he need to pay the time only he calculate. Now this is the amount to record in the purchases or the sales. 2 radio were 40 and returned to Nazni. What was the total of the credit notes issued by Nazin? So this is the actual, the net selling price. So we take 8 times the 2. 8 times 2 is 16. Okay, the answer should be 16 only. This one not relevant because they are not talking about the payment. They are talking about the goods return. Credit note is about the goods return. Okay, I move on to the next. For question 7. Elisa entered the credit notes she received in March in the correct return journal. In the correct return journal, credit notes Alice enter. She received. That means she is a buyer. Okay. Then buyer will record purchases return journal. How was the total of this journal record in the ledger at the end? So your this amount, end of the year, end of the month, you will transfer to the general ledger under purchases return account, which is in the credit side. Whereas in the purchases ledger, you will record the supplier name, which is a trade payable supplier name, is in the debit side. So here this talking about the ledger. What is the ledger they given in here? They say credit purchases return account, which is this one. This sales is not because buyer do the recording. Whereas debit purchases return. Here I put credit, so this is no. Debit sales return, this is not the sales because buyer do recording is a purchases. So the answer should be A. For the 8th, which item would not be shown on a bank statement. Bank statement is a document from the bank to the business. So a check written by the bank marked as a referred to. This is a bound check, which is dishonor check, which is bank rejected. So it will appear in the bank statement first. Then after that, only the trader will know. A monthly payment made for the electricity by direct debit. Direct debit also the banker will know first. So bank statement should be updated already. Bank charge is the bank is the one do the recording first because they charge us the amount. So this one also appear in the bank statement. Unpresented check. What is an unpresented check? In your cash book, when you have a receipt, this is a receipt. This is a payment. So this payment made to the supplier. When the supplier didn't go to the bank to take the money, this payment we call unpresented check. Whereas in here, if we receive from the customer, this is called uncredited amount or the amount not yet credited. So these two double entry, which is appear in debit and credit in here, these two will appear in your bank reconciliation statement. And these three items, A to C, you have to update cash book to show the latest balance for the cash book. Okay? Okay, next. Okay, question 9. Which statement about a purchaser's ledger control account is not correct? Purchaser's ledger control account is just like the trade payable, but they say not correct. It acts as a check for the balance of the purchaser's account. Purchaser's account is to record individual credit supplier. This is to record total. This is the record individual. So this is, it's not correct. Balance of the purchaser's ledger account is include transaction related to all the credit supplier. Okay, this one include all the credit supplier, correct? It is prepared using information from the, okay, this is from the book of prime entry, correct? It's provide proof of the arithmetical of the, oh, sorry, this is purchaser's account is not purchaser's ledger. The differences here, these two, here is a purchaser's account. Here is a purchaser's ledger. Purchaser's ledger is record supplier. Okay, I didn't see clearly. This is an account. This is a ledger. The differences between the term purchaser's account, purchaser's ledger, purchaser's journal. Purchaser's journal is to record all the credit, the list of all the credit purchases. Okay, whereas ledger, purchaser's ledger is to record individual supplier account. This one behind its account, this is under general ledger, which is record credit purchases and also cash purchases. So this is the differences. Why this one is wrong? Because of these words. Here is the account, not the ledger. Okay. If they change it to the ledger, yes, to check the balances, it is similar to what we have in here.
Okay.
Okay, next, JB sales ledger control account has a debit balance 12 increase on the overdue account. Okay. Sales ledger control account, we have debit balance 12,000 and interest on the overdue 40 and the discount allowed has been omitted. Interest overdue means that we have to charge customer 40. Discount allowed we give to the customer, show in the credit side. What was the correct balance? So take this total minus this one. So let me count 120 plus 40 minus 150. So we get 11890. So the answer should be this one. Answer should be B. Okay. Now let's continue. Okay. Question 11. Okay. The question 11 is that what is the effect of treating an item capital expenditure as, okay, when we treat capital expenditure as a revenue expenditure, the non-current asset will reduce. You give me a minute. Okay. So our non-current asset, because capital expenditure normally refer to the non-current asset. Non-current asset will be understate. Revenue expenditure will be overstate, which is expenses lah. Okay. So in here, cost of non-current asset overstate. That means this is wrong because should be understate. Cost of non-current asset understate, yes. Depreciation for the year is overstate. When we don't have this one, that means we didn't charge the depreciation. Depreciation will be understate as well. So depreciation for the year will be understate also. So the answer should be 2 and 4. So it should be donkey.
Okay.
Next is, why does a business provide depreciation? So the purpose of depreciation, what is the depreciation definition? Depreciation is an estimate cost, estimate loss of the value of the non-current asset over its useful life. So this is under the prudence saying that we must charge the non-current asset. To charge the cost of non-current asset against profit, this is not against the profit. To use the non-current, to ensure non-current asset appear at the book value in the statement of financial position. Okay. To ensure the matching. Another prudence, this is I'm talking about prudence, means that not to overstate the profit and the losses and the asset. Whereas in here, matching concept is talking about that the cost of the expenses, incurred match against the revenue earned. So this is also can be used in this sense, whereby when we charge depreciation, because we use our machine, use our non-current asset to generate the income. So the income that we generated using the machine, there is a revenue earned. So therefore, we have to charge the depreciation to match the revenue that we earn. So that from there, for this, after we prepare this one, we will know what is our actual profit or the losses, which is, this is part of the financial statement. We prepare income statement. To retain the cash, this is not about the cash. Depreciation, for this depreciation in the accounting, basically this is a non-cash item, purely accounting standard requirement. Yeah. Next, let's see what else. Page 14. The following, this one is rent receivable. This is a liability, current liability. This is also current liability. This one we receive because this is a income account. Okay. Now there's which entry was made in the income statement for the year ended. We already have this one, but there's a one item missing, which is income statement in here. So here, income statement, in your income statement account will be in the credit side because credit is an income. Debit is a expenses. This is an income account. So how much the income? We take this one, 4,000 minus 600, we get 3,400. So this 3,400, they say that make in the income statement, which is this side. So it will be credit side. So how much? 3,004. Okay, move on to the next. Okay, 16. 15. Okay. Why does a business maintain a provision for doubtful debt? In this one, you have two, prudence and matching. Normally, these two principles are applied a lot in the chapter. To apply accounting principle of the prudence, yes. Okay. To avoid profit for the year being understate, no. It's to avoid overstate. Okay. To have an accurate forecast of the debt which will be uncollectible. This one, accurate forecast, this is just an estimation. So it's difficult for us to just estimate. To reduce the expenses of the irrecoverable debt in the future. The purpose of it is that we want to make sure our, under this is, if under the matching concept, the matching concept saying the expenses incurred. So this to cover the revenue earned. So when we sales, now we foresee in future may have some irrecoverable debt. So that's why we need to make sure we take into account under matching concept, we recognize the loss immediate, the possible loss possible to match this one. So this one to reduce expenses for, this is not about this one. This is mainly because of the prudence and the matching concept, which is that in here, to apply the accounting principle of prudence. Okay, now I move to the next. Okay, question number 18. Which item will appear in the income statement as a service? Service means that no inventory. When you know inventory, you do not have the gross profit. So gross profit, no. So it's either C or D only. And then profit for the year, yes. Surplus, this is under the club account. Club account is under the considered service, but this is not because they say income statement. Okay, so since these two is tick, that means this is the answer. Okay, now next. Okay, question 20. Which is added to the owner capital to calculate the capital employed? The component for the capital employed, there you have two. One is the capital or the equity. This is under sole trader. This is under limited company. Another one is non-current liability. This is a fixed one. Okay. Next is that question 22. X Limited start the year with the ordinary share. And ordinary share dividend, this one is pay. This one had to minus. Later, a further 10,000 ordinary share was issued. This one should be plus. And then the profit for the year is plus. By how much equity increase? Okay, we calculate end year how much was. Take 100,000 minus 3,000 plus 10,000 and then plus 8,000. So we get 100 minus 3 plus 10 plus 8. So we get 11500. The question is talking about equity increase. Means that you take this one and compare with this one, 15,000. Okay, next. Okay, question 24. Okay, question 24, we have every member of sport club required to pay an annual subscription fee. The subscription fee account show the below. So the annual subscription is 50. Bank, and then balance brought down. This is a current asset. Income statement, balance CD, this is current liability. This is a current asset. What was the increase in the number of members in areas between between January and the 31st. In areas means that we are talking about this one and this one. This is the income in areas. Okay, this is the income in advance. Okay, the number of member in areas between these two. So one person 50, that means the 350 divided by 50, you get 7. Whereas this one, 750 divided by 50, we get 15. So 15 minus 7, we get 8. Ready? Okay, next. Which of the term used to describe surplus in the club and is over its life? Okay, this surplus over its life means that under the statement of financial position, this club account, you have non-current asset, current asset, and then here accumulated fund. After that, non-current liability, current liability. This is what they're talking about. Over its life means not accumulated fund. Okay. Next, Nula provide the following information for the year ended 31st March. Drawing, net asset. So this one, net asset means the capital. Capital. So what was the profit or loss for the year? We open the sympathy account for the capital. Opening must be in here. Closing must be in here. Drawing must be in here. The T account concept. So now debit more than the credit. That means we have the profit. So 3900 plus 72275 minus 6050 and 760. So 15675. So the answer, we should get the profit 15. So donkey. Okay. Now let's continue. Need to move a bit faster because I got class. Okay, we finish out this paper first. Let's finish out this paper first. A trader who does not keep full accounting record was able to supply the following. How much the credit sales? So we have, this is a trade receivable. You use trade receivable. Amount owed by trade receivable, beginning year, 3,000 in here. Check received from the trade receivable during, this is a bank amount. Cash discount given to the trade receivable. This is a discount allowed. Amount owed by the trade receiver at, this is the balance CD. Balance CD is sitting in here. So we want to find the credit sales. Take the total credit minus the debit. 28,000 plus 5,005 plus 4200 minus 3,000. So we get 30,700. So the answer should be donkey. Okay, next up. 28. A trader provide the following information: revenue, inventory, a markup. Markup formula is that gross profit over the cost of sales times 100%. So we have, what was the purchases? So we take the revenue minus cost of sales. We get the gross profit. Okay. And then this is 100%. This is the 25%. And our revenue will be 125%. 125 minus 100, you get 25. So we have this one pair. So we find the cost of sales first. So how to find the cost of sales? We take 120,000, 120,000 divided by 125 times 100%, which is this 100%. We get the cost of sales. We get 120,000 divide 125 times 100. So we get 96,000. So cost of sales formula is an opening inventory plus purchases minus closing inventory. Opening inventory is 9600. Purchases we don't know. Closing inventory is 10. So bring the two items into there. So plus become minus. So 96,000 minus 9,006 plus 10200. So we get plus 1020 minus 9600. So we get 96,600. So the answer should be donkey. Okay. Now next continue. Okay. 29. Josh provide the following information. Asset test current asset minus inventory to current liability. Means that don't include the inventory. Okay. And then non-current liability, non-current asset is not included in here already. So they say that what was the bank overdraft? So we only have one trade receivable, which is 18,000. And this one, bank overdraft, we don't know. So this is X plus the trade receivable 8,000. Okay, this is 1. This is 1.2. Okay. I want to find this one. I need to take this one divided by this one. Let me see. Cross method. Okay. So I get this one go up, this one come up. So 18,000 is 1.2x plus 8,000. So I get 1.2x, 8,000 times 1.2. I get 9600. So I bring it to here, become 18,000 minus 9600 divided by 1.2 equal x. So 1800 minus 9600 and then divide by 1.2. I get 7,000. So the answer is A. Okay.
Right.
Next is that question 30. Okay, revenue. It was found that closing inventory has been 400. What was the correct inventory? Okay, this one I changed to 400. So that means this amount I should reduce 100. So become 2300. So what was the correct? So the formula for rate of inventory turnover is the cost of sales divided by the average inventory. So my cost of sales become 2300. My average inventory is 100 plus 400 divided by 2. So I get 2300 divide 500 divided by 2 is 250. 2300 divided 250. I get 9.2. The answer should be C. Okay. Next is 31. Okay. The current ratio of X is 2 and then Y is, okay, current ratio, this is liquidity. More is better. That means X basically is better than the Y because here is 1.20. So X has a fewer liability. This one we don't know because they don't give us a value. So this one we cannot assess. X has more liquidity. Yes, this is because the ratio for current ratio and quick ratio basically is talking about liquidity. This in terms of the value, we do not know. In terms of the inventory, also we don't know. Okay. The only take notes when come to current ratio and the liquid ratio or the quick ratio, we talk about liquidity.
Okay.
32. Which external party? External party means outside than the internal one, which is non within the organization, will be interested in financial of the trader. Banker is one of the external because they want to give loan. A trade union is the outsider. This basically this is an employee. They represent the employee. You can treat it as a internal as well. Because their purpose is they want to fight for the employee because this is considered internal. The business manager make decision about the how to increase. Business manager is the employee. Employee is an internal. They want the external party. The trader decided if the trader means the owner. Owner is the internal. So in this case, these two cannot be. 3 and 4 cannot be. 3 and 4 cannot be. That means this trade union they treat as a external party, because this employee is internal, but trade union is external.
Okay.
Next, okay, the last one, 35. Okay. Accounting objective got 4. Comparability, reliability, understandability, and one more, relevance. Here they don't have lah. Okay. Information from the must be free. The keyword in here is a free from the error. And when you saw error, free from the error and bias, this is reliability. That means this one, B or C, the answer. User must able to identify differences and similarity. Differences, similarity is talking about the comparability. So the answer should be B. Understandability means that the accounting that we prepare must be let people understand how we want to ensure the user understand. We follow the IAS, which is the International Accounting Standard. So the user had to go and learn himself the accounting standard in order to understand the financial statement. Okay. So that's all for today. We do it